So my voice is a little bit off because of I was talking a lot at the conference. All right, I guess we're ready to go, so give me a second. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed and tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, TSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities. Licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services and meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and the results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, fantastic. I feel good about that. All right, let's see. What are we going to talk about today? First of all, any immediate questions? No immediate questions. That's fantastic. And let's see how our indexes are doing. Oh, actually, this is good. We finally have Sunday. You know, most days, frankly, we don't exactly at 1 o'clock have great things to trade, so we end up just moving along. Right now, though, this is going to be interesting because we're going to hit this nice resistance on the Dow at 17,565. We might get, I don't think we're going to get 10 points on the S&P. So you have the Fed is coming up, right? So we got to watch these nice resistance 1 lines. These are R1 lines, basically. And we're hitting them kind of across the board. So whoever's closest to the R1 line, we're going to want to short into the Fed. Ooh, and it looks like Nikkei may be the winner. Look at Nikkei. We like shorting them anyway, so that's fantastic. All right, they're way up there. Ooh, Netflix. I should just short Netflix up here. So we're going to watch these, but we have the Fed is at 2 o'clock, so we're going to stay on our toes. They're going to put out their minutes. The minutes are meaningless, of course. You know, it's not there's nothing to it. They're going to put out the minutes, which are going to say the same BS they always say. But the most important thing is going to be the spin that's put on it and how people interpret it. But the bottom line is they're tightening. They're going to tighten. The minutes are good. So certainly the minutes are going to indicate the intent to tighten. Regardless, you know, the minutes don't know what happened since the last Fed meeting a few weeks ago. The minutes are the minutes of that meeting. So they're only going to tell you what they thought at the time. And clearly every single Fed speaker since then has said, we intend to tighten in December. So obviously at the last meeting, they must have discussed that they intend to tighten in December. Otherwise, this is going to be the most confusing minutes ever put out. Anywho, so a nice move up in natural gas here. We just almost tapped the 240 line. Let's get a close-up of that trade. That was my trade from the Morning Post, which I said was good. And it was. This is the NGJ. Oh, I own these. See, that's nice. When you open 10,800. So these guys are up and down and all over the place right now. I've got 12 long. These are the April contracts, the April 2016. So I'm not exactly running in and out of these. The ones I was playing with this morning were the regular NGs. Up here. And I started the day, so I'm sure I'm lost for that, because I started the day with some. They went down and then they went back up, and then I just got out because I was done with them. So that contract, well, the show's a loss, but they were up like a huge amount because they came in from, the reason it shows a loss is because we were up here, and so my net loss from being up here and not getting more sold is down there at 1,700. But it's a loss for the day of the 1,700 of the huge amount that we made last time. So that's not terrible. But those are the Decembers. We're done with those. They only have a couple of days left to go. So you don't want to be in a contract that's about to expire unless you're day trading, which we were this morning. So when I made the call this morning in the Morning Post from the 230 line, we went way better than 5. And that's $500 per contract at 5 cents. That's a nice move. What I did instead of buying these, though, is I bought more of the J6s. So I added, I think I had 6 long and I doubled down. So I doubled down here. But, oh, I'm sorry. I doubled down, but it actually made my net worse because my net was down here somewhere when I first entered. And that hurt my day, actually. So my net was down here, and I added more at the 250 line. I doubled down. So it actually in this particular case, I doubled down, and my net average got worse than it was because it was down here and it brought it higher. But I just wanted more. You know, I mean, bottom line is I have great faith in this thing going. As I keep saying, I have great faith in this going back to like $3. So 12 contracts. If we make the 50 cents that I'm looking for, it's going to be $60,000 at some point. And it ain't going to get there pretty, I'll tell you that much. So in between, I'll be day trading those front month contracts to take advantage of the dips. But we'll see how it all works out. Meanwhile, you got the dollar way up, 99.75, coming close. So the Fed, with a good tightening note here, can push this over $1. That's going to probably shove everything low. Gold was just at 106.8. Silver touched 14.08. 106.5 here. That's got to be a multi-year low. I mean, that's, I would say, I don't even know. Can't even tell you when the last time we've been that low on gold is. Maybe somebody knows. Oh, wait. We can go to the chart for that. Hang on. That's right. Oh, no. We can't go to the chart for that because this stupid thing, it never shows it correctly. Oh, here you go. Metals. Gold. You have to do it incognito for some reason. And if we go long term, yeah, look how far back. 2009. Nope, wait. Now call it 2010. Okay, I'd say 2010 we have this little spike down. So basically, it's been more than 5 years since we've had gold this low. All right. Now, I think it's a great buy. I think 1,000. Look at 1,000. That's definitely consolidation under 1,000. We broke up, never looked back. Now we're coming back to test 1,000. And the funny thing is, I mean, if you look at it from a really long-term perspective, we go from 200 to 400 to 600 to 800. We pull back to 750. We consolidate down here. We're up to 1,000. Then we go up to 1,500. Not even much consolidation there. We blow up almost to 2,000, and now we're just pulling back to 1,000. But in the long run, this is just a retrace. It's just a 40% retrace. See, this is what, 250, 300? So that's I know it's 250 because I remember thinking of buying a ton of gold at the time. It's 250, and I knew I should have done that too. I was so pissed. I was just going to buy gold and say, screw it, I can just go away at this point because it cost $250 at the time to make gold. And it's the same logic I have now. It costs $1,000 now to make gold. At the time, it costed $250 to make gold. I said, well, it's not going to go down lower than it costs to make it. That was a pretty simple premise. So now we're here. But basically, if you look at the run from 250 to 1,000 is a 750 run. How much of a pullback do you get from 750? You're going to get a 20% pullback, which would be $300. So from 1,000 to 700 is a 20% retrace. Oh my goodness, look at that. You see, it's not complicated. $750 run. I'm sorry, not 20%, 40%. That's a strong retrace. Here's a 20% retrace, and here's a 40% retrace. Weak retrace, Strong retrace. Come back, hold the weak retrace, rally on. All right. Then what's the next rally? 750 to 1500. Then if you ran to 750, 250 to 750, then you're going to go from 750. I'm sorry, 750 is here. From 250 to $1,750. From 1,000 to 1,750 is your next point. All right. So we're looking at 1,750 over here is where gold is. And now in the large run, from 250 to 1750 is 1500. That means you expect a 300-point drop is a 20% retrace. So from 1750 to 1450, that's a 20% retrace. And from 1450 to 1150, no, to 1100, sorry, 1450 to 1100 is a 40% pullback. So that's all we have here is a strong retrace off of this gigantic rally. And that means we might get some consolidation down here, and then hopefully we'll make a real attempt to pop over. So I like gold for the long term. It doesn't mean it's not going to go lower. It doesn't mean it's not going to test 1,000. But over the long haul, I think it's just basically consolidating on the way up to higher prices. Could take a long time. I mean, these are months, so this could take, when I say, oh, it might go here, that's like 3 years. So it could take a while before it comes back, and there's no guarantee it's going to take off quickly. But long run, the same way I regret not putting $1 million into gold and just leaving it alone back here. That's what you're going to be like here. You're going to look back. Does it matter if I would have put it in here or here or here or here? No, it doesn't. But if I put it in here, and don't forget how violent this move looked, because I put it in here at like 200, and then it went to 250, and then it went back down to like 225, I'd be like, oh man, oh, gold sucks. Oh, I can't believe, get me out of this thing. This is no good. You said it would go up, and look what's happening. It went down and down and down. Because that was pretty drastic when you're in it. Now it's a little squashed. But those are pretty violent moves down there. And look at this move. It went from 400 almost in half. We're not in half. What we did is go from 1,800 to, well, if you count the spike at 1,800, but all we really did is go from 1,800 back to 1,000. It's still not half. 900 is half. I don't think we're going to get there. I think we're just going to cruise along and head back up. So I like gold. Silver, probably the same deal. Silver was flatter for longer. Then it took off, went way back down, took off again, way back down. But the thing about silver was stupid up here. This was pointless. This never happened to gold. Gold didn't go up that much. Silver just exploded. And now it's completely collapsed. If you look at what realistically silver should be, this is a $5 line. All right, so silver from gold went from what, 200 to gold went up 7 times. So 7 times 5 is 35. All right, so figure somewhere around here might be the realistic top for silver, about 35. Probably this is half of where it should be. But even so, who's to say this is, should have happened in the first place? There's a little bit of a greed going on there. And here, and then we get the same thing though. It's the cost of producing silver, which isn't quite 14, somewhere probably in the 12s. So you're still going to have a floor there. But these are long-term floors. I mean, this is a monthly chart. Every tick is a month. You guys are like staring at these trades like a week later saying, how come it didn't move? Or why did it go against us? Like, who cares? Who cares what happened here, and here? You play these things for a long-term trend. You don't play them for like what happens tomorrow. That's essentially unpredictable. Okay, what happens over the long run, that can be predictable. But what happens over the short run, very unpredictable. Right? It's not the tide. It doesn't come and go at the same time every day. All right, let's see if there's any questions. That thing, no, wrong one. Always guessing wrong. Let's see. Only one. I joined a few minutes late. Could you talk about energy potential, especially whether it's going to get colder over the week, next couple of weeks? Well, Again, it's like, you know, it's not our job to be a weather expert. It's not our job to forecast things. If you go to Accuweather, which is what I do a lot, Accuweather, and, oops, Accuweather. Now we go to, now we go to maps, and we go to forecast maps, and we go to trends. And there you go. It's hot right now. And it doesn't matter. Nobody cares what the weather's like in the Midwest. Nobody in the Midwest, the West Coast. Nobody's trading natural gas futures in the West Coast, so it doesn't matter. People are going to work in Chicago, and people are going to work in New York. What the weather's like, we're trading the contracts. It's warm here. So that's not good. All right? Here is where it gets fun. Now it starts getting cold. All of a sudden, all of us people who are walking around in T-shirts next week are going to get cold. Because normal, don't forget, normal is cold. Above normal is what we have right now. It's 50 degrees right now in New York City. So 50 degrees is above normal for whatever the hell date this is in November. What is it, November 17th? So for November 17th, 50 degrees is pretty damn warm. Normal for November 17th is 30 or 40 maybe. So it's going to drop really fast next week. And the week after that, it's actually going to be colder than normal. Colder than normal for Thanksgiving is snow, 32 degrees. So in the next 2 weeks, the temperature is going to drop about half. It's going to drop like 1 degree per day on the average for the next 2 weeks. That's pretty fast, and that's pretty nasty. So you think of it from a trading perspective, what are they doing? Traders trading contracts. They know there's a connection between the temperature and the price of natural gas. They go home and they turn up their thermostat. And every time they turn up their thermostat, they think about how much money that is the natural gas all over the country. So that's how psychologically it works. Now, it's also telling you here that in the 30-day comparison, now let's get the 30-day comparison includes the fact that it's over warm now. But in the 30-day outlook, it's warmer than normal. But then that, in 90 days, we're going to end up with a pretty normal winter, including the warm patch we have now, by 90 days. And again, it's just Accuweather. Who knows if they're right? But they're actually pretty good. I use them a lot to just get the gist of what's happening. And what they're saying, though, is that over the next 3 months, the weather will normalize, but that means that the 90-day average will become normal. That means that the 2 months after the first month are going to get colder than normal. So temperatures will drop pretty nicely for the next couple of months. And we're going to have a proper winter. Then you've got the El Nino stuff. And that's going to end up causing a lot of snow on the West Coast, most likely. A lot of rain, a lot of snow on the West Coast. Some good snowstorms in the Midwest. Well, it's good on my end now. Yeah, I just put the screen on, that's why. All right, let's pretend nothing went wrong. Yay. All right. Now, let's give everybody a minute or two to come back. All right, that was a shame. I don't know, something happened on my computer. I'm blaming Windows 10. I really don't like it. It does weird things sometimes. It seemed like it was helping at first, but now it sort of like has a mind of its own. So we'll have to figure out what to do about that. Let me use my other computer for this particular function. Let's see. All right, so where was I? We were talking about, I forgot. Let's see if we can go back and figure out what I was talking about. The futures? No. We were at some point talking about the futures. All right, I would like to show up the NIKKEI below 19.8. That'd be a fun play if we can catch that on time. And cold weather. Oh yeah, thank you. Back on topic. All right, so anyway, so that's right. We were talking about the United States temperatures. So generally, it will get cold. Winter is coming, as they say in Game of Thrones, and it will get cold. There will be a wall of ice covering America, and everybody will say, "Oh my God, get me some natural gas." That's my theory, and I'm sticking to it. All right, that covers that. Now, that was the only question we've had all morning, so we're in good shape now. Yep, that was the only actual question. So if you have a question, now is a good time to ask it, not an hour from now when I'm trying to end the meeting. All you guys do that at the end of the meeting. Suddenly decide you have questions. What else are we doing? All right. Oh, portfolio. I knew I was going to do something else. This is when it all went to hell. All right, the 5% portfolio has gotten hammered on its open positions. We're only up at 6.8% now. I'm taking a big loss on some of these, but you know, but it's not a loss unless we intend to take it. As far as our closed positions go, what the hell? Oh, 2015. We closed $27,000 in profitable trades in the 5% portfolio. We just haven't had some really crappy ones open, but they're longer-term positions now, and we have to figure out how to work our way out of a jam so that we don't take these losses that we're showing. The big losses are in BID, Sotheby's, and in SQQ. That one's not going to go away. That's just going to expire that way. That's it, really. We got a big loss in Sotheby's. We have a big loss in SQQQ, which is protecting the other stuff, and the other positions are just basically on the disappointing line at the moment. Oh, here's gold, of course, GLD not doing well. We're going to have to move that one and add to this position as well. None of these are terrible. Oh, what's that? Netflix. Oh, and Netflix is hitting us right now because our puts got killed. All right, so that was really bad. Look at that. That went from being positive to negative. That was a big hit in our portfolio. So we shall have to see what happens there. That one's definitely not good, though. Let's see what Netflix is. Netflix is not being good to us at all. NFLX. What the hell? Seriously? This is the weird thing about Windows 10. There's some stuff it just won't do. Like it has these ridiculous problems resolving certain things. I don't know. I wouldn't know if it's Java or what the hell it is, but look at that. Calendar view. NFLX. Yes. Go. Look at that. It won't do it. I have no solution for this. I have no idea what to do. I wonder if I open it in a... See, that's weird. If I open it up in an incognito window, and I don't really know what the difference would be, but if I open it up in an incognito window, it works, which is the same thing I'm getting with Finviz. All right, so here's Netflix. That sucks because we were doing great, and now we're doing terribly. So we'll have to see what happens here. We're not going to sit back and just watch it. If it stays this way through expiration, if it doesn't come back down, we're going to have to adjust that trade because that's too much money for us to mess around with. Now, on to, in this weekend, we had our butterfly seminar down in Washington, D.C. We talked all about our butterfly portfolio. And it was at 85%. It's gained about 3 or 4% this week. It's very nice. Oh, wait, before we get into that, I was going to look at the short-term portfolio. The short-term portfolio lost like $20,000. It was up over 250% before today. But the pop, I thought, well, maybe it was like Monday. But the pop has really, really whacked it. Because generally the short-term portfolio is bearish. And Amazon is back up. That's annoying. So we have to see how that goes. Gold, of course, $10,300 loss on gold in this portfolio. We have double the position. So we'll have to see how these things work their way out. FXP shouldn't be a loss. That's weird. All right. Well, it doesn't matter what that says. That's just something to just poor positions. So SLW. No, where do we have UNG then? Ah, I'm confused. Is the UNG in the 5% portfolio? Did I miss it? Oh yeah, here it is. Okay. So in UNG, we have 2016 January. That's coming up soon. We have the $12 puts, and we're quite a bit below them. All right, but we sold them for 90, so the loss is only $1 at $10. It's not like a desperate thing. We're going to roll them, and it's not a big deal. In April, our target is we have the short $11 puts, so we're looking to get back over 11 by April, and we have the $8 calls that are in the money, but not by much. But basically, we bought them for $225, and now they're $209, so it's not a tragic situation. All right, so that's the way we were playing natural gas using options. The April 11 puts, so forget the 12, these are old ones. So it's the April 11 puts that are now sellable for $182 against the April 8 calls that are buyable for $209. Roughly, those are probably both bad prices, but just to give you an idea of where they are. So that's how we're bullish on natural gas into April without using the futures contracts that we're using on our main system. And let's see where they are at the moment. And that's with natural gas at, there it is, 235 again. All right, so it's 235 natural gas, and that puts UNG right at almost $10. So we're looking for about a 10% improvement here, and a 10% improvement is going to bring us to $3 here and 0 here. That'd be nice, because if natural gas goes up from 235 to 270 between now and April, this spread is going to go up 10%. And that means that the April 8 calls will be $3 in the money, and these calls will expire, these short puts will expire worthless. That, if you did an even amount, would give you a $3 gain. So how would you like that? You spend practically nothing on the spread, and you gain $3. That's a pretty nice way to play. So I do like that going forward. Okay, let's see. Oh, okay. Get caught up here, see where we are. Waiting for OOP review. Well, we're going to do an OOP review on paper. We're going to go over the positions. I'm not going to go over one by one right now. Can you talk about filling spreads? Yes. That's been a big topic of conversation, filling spreads. I've done this before, but I guess we have to keep doing it because it's important. We have this BHI play. What is our BHI play? I honestly don't even know what our BHI play is. Oh, here it is. Okay. On BHI, we're trying to buy the January 45.60 bull call spread. The net of that spread is 735. I got to write this down. Or actually, let's see. There you go. Now I can see. All right. So the net of this spread is $7.35, and it's a $15 spread. The $50 short puts is $7.24. That means this whole spread costs 25 cents. People say they can't fill this spread even though, and this is what blows my mind, even though BHI, you son of a bitch thing, I hate that. All right, even though BHI itself, if I can find, that's what probably crashed us, is those windows. Oh wait, okay. Even though BHI itself goes up and down and up and down and up and down and up and down, it doesn't make sense. But here's the problem. You guys are not filling it right. I imagine that a lot of you guys ask for the spread. So let's take a look at what that looks like. If I want BHI, and it was what month? It was January, right? It was 2017. So the $45 calls right now are $11. The last sale on them was $11. Let's see what that looks like. So I'm gonna right click here. I'm gonna find more info and go to Quick Chart. And here's my Quick Chart. And you can see $11, and you see the date up here, 11/16. That's like yesterday. So these were sold for $11 yesterday. There's not really any other information on them. There hasn't been a lot of sales lately. The 60 calls, on the other hand, I'm going to do the same thing. Go to here, more information, Quick Chart. And as of 11/16, they were $4. So yesterday, that spread was $7. That's less than we've been talking about. That spread went off to somebody yesterday at $7. People are telling me they can't fill it to $7.50 for the last month. I can't even comprehend how that's possible. I think your broker is a crook if you can't fill this spread. Well, what do you do when you want to get it? Well, obviously, I'm going to say I want to buy these contracts, and we did 5 of them. So I go, I don't want these, that's a problem, but just for an example. So you put an offer to buy 5, and you set your price. Now, if the price is 11 at the moment, was the last sale, I'm going to set my price to 10 or 10.50, depends how bad I want them. All right, but for $10, I'll totally buy these. So I'm going to set my price to 10. And you would set your limit, instead of a day trade, you would do good to cancel, GTC. I'm not doing that because I don't really want them. But you set 10, and you say that I'm going to buy them and it's a limit order, not a market order, not a stop limit. There's all kinds of things you can do here, but it's a limit order. I will pay no more than $10 for these calls. Limit order. Then you say confirm, and you send your limit order. That's all you do. Boom. Now you build the second leg of the spread, the $60 calls. And I want to sell those. So I'm going to say sell, single. And I'm going to say I want to sell 5. Whoop. Okay. And I want to sell them for, I'm not going to sell them for $1.85. You see how ridiculous that is? That's the ridiculous low price that is being bid. The ask price is $5.50. I want to sell them for $5. I'll ask less than the guy who's asking $5.50. Can't even, it's not even worth doing it by clicking. 5. So I want to get $5. And again, it's a limit order. It must come in for $5, and I would do it good to cancel because I want to pick them up eventually. Then I'm going to confirm and send that one. See, now Thinkorswim is telling me I have an order here, and says, you see, it says view order. I have an order to sell 5 for $5. I have an order to buy 5 for $10. Now, do I really expect to get the spread for $5 instead of $7? No. But you know what? Whether BHI goes up or whether BHI goes down, one of these 2 legs are going to fill up my price. I'm either going to get $5 for the short calls, or I'm going to get $10 for the long calls. There's only two possibilities. It's not going to stay where it is. These prices are already drastically different than where we were looking at them last time. Now, after I get my first fill, then I need to get a little more realistic about my second one, unless I happen to hit like a spike where, like Monday, where it spiked down in the morning, right? On Monday, everything spiked down in the morning. In fact, here's BHI. BHI. Look what happened Monday. Oh, well, actually, you can't tell. On Friday, it was down. See, on Friday, you would have easily gotten your fill on the long calls. And frankly, on Monday morning, BHI spiked up. It didn't spike down because oil was up on Monday morning. So BHI, you would have filled this leg here, and then you would have filled that leg. If I fill my, see, it's a different action because if I fill my short calls at 5, that means it's going up, and I might be nervous that it's going to keep going up, and I'm going to end up short on BHI, which is not my intention at all. So I would be quicker to cover and sell and buy my calls if I have to. And by the way, if this one totally gets away from you, so what? Then I'll sell this 47 instead and take a slightly smaller spread. I'm not going to spend more money. I'm going to take a smaller spread. I'm only paying net zero. What's the difference? I'll make $8 instead of $10. It's a $15 spread, so I'll turn into a $13 spread, and I'm still paying net zero for it. So you don't go chasing it and paying more money. If you can't fill this one, move to the next strike. What's the frickin' difference? You still have a $13 spread for free. All right, and the same goes on the put side. We sold what, the $50 puts, and look at that, it's still the same price. We sold them for $7.24. You can sell them for $9.59 now. This spread is much better than what we had before. And also that goes to part of the net of the spread too. So if I offer on these to sell them, well, first let's look at the chart. You always look at the chart before you do anything. Why is this chart so, is it because I have a 5-minute chart, or have I need more space? So that usually you see a lot more ticks than that. Oh, here you go, 5 minute, 1 hour. There you go. Okay, now you can see what's happening. So it was as low as $6, and you can see the date is on the 4th or the 3rd. It was $6. Then it was $7. Then it was $8 last week, and as of the 13th, Friday, it was $9.59. Now the bid is $7. We wanted $7.24. The bid is $7. The ask is $10. I'll be happy if I can get $9. See, now also you have to do the math. If I can get $9 for this one, then I can pay $9 for the spread because it still comes out zero. That was my intention, was to net zero on the spread. So here I'm going to offer to sell, and I'm going to sell 5. Whoops. 5, 4, $9. Which is a good deal because the last guy who sold 5 got more than I did. So I'm going to sell 5 for $9. And again, same. It would be, in this case, it would be good to cancel. Boom. And now I've got to sell here too. And then you click on it, you can see what you got. So, if any of these fill, I then have to determine what else I want to do. So, what if the short puts fill? I'm fine with that. I could run this whole trade with just the short puts because I'm going to make $9 as long as BHI is over 50. That's essentially my premise anyway, isn't it? So if just the short puts fill, that doesn't change anything that I'm doing strategy-wise. Because I'm perfectly happy just having the short puts. Because and again, why are you in this trade? What do you think is going to happen? I certainly think BHI is going to close about 50, or I wouldn't be doing this in the first place. So BHI is going to go about 50. My real target is 60. But 50 easy, and don't forget you're collecting 9, so really anything over 41 is a winner with this. I got no problem if that's the only part that fills. That would have no bearing on my thing, except that if I do fill this for $9, that means I have $9 to spend on my spread before I even go negative. Oh, what the hell's that? Somebody just filled at 888? See how 888 just appeared on the screen? I think somebody just undercut me. Bastard. All right. Anyway, so once it fills for 9, we only expected to get 725. So if this fills for 9, that means that we can then have an extra $1 to spend on this area. But even so, the discipline is just wait for it to get your prices. Because if we get our prices here, we're going to have 5, and we'll still get 9 over here. We end up with a $4 credit. That's fantastic. A $4 credit turns us into a $19 spread for us. And every trade you do should be like that. When you're entering and exiting, you should always be looking to get the best price. It's not an emergency to sell these things. That's why we start setting up like to do our butterfly rollovers on, is it Tuesday already? It is already Tuesday. So on Tuesday, Wednesday of the expiration week, we already set up all of our butterfly trades that we're going to be moving. We already set up everything else on expiration week that we want to change, because that way we have them ready and we can ask for our price during the week. And the normal volatility of things going up and down during the week means we still probably 75% of what we ask for we get. And then in the end we clean up and we get the ones, some we don't get a great price on, but generally we get good prices. And if you mostly get good prices, you're going to improve your performance drastically. But what you never, ever, ever do, unless you're saying, I'll take this trade, unless you're saying, I'll take the spread, but only if the spread is offered at this price. So in other words, I could say buy a vertical, and this is showing me I already have all these positions that I've offered. But if I want to buy a vertical, I can say buy 10 of these and sell 10 of those, and here's the 45 strike and the 60 strike. So I'm buying the 50, I'm buying the 45, selling the 60s. They're telling me, Thinkorswim is telling me I can get that spread for $8. So if I confirm that now, I'll probably get it. I want it for $7. So you can put it in to say I'll pay $7 for this spread, but the reality of that is that you probably are not going to get it. Thinkorswim is going to have a hard time filling it because they don't like to fill it for less price. No, you have a market maker on each end of that trade, both trying to rip you off. So the chance of them both suddenly deciding to accommodate you at the same time is infinitesimal. But if you kind of want to spread, but you only want it if you get your price, that's when you would use this and put it in. And if things happen to go your way, then maybe it'll work out. But it's a terrible way to try to fill something. That's how you guys end up sitting there for a month not filling orders. But if you do this, if you offer to buy and sell, and you put all your offers in at good prices, if the stock goes up, then the short calls are going to fill, right? If the stock goes down, then your long calls and your short puts are going to fill. But either way, something is going to fill for you. You can't not fill anything. That's not possible. Okay? And obviously there's a little bit of intelligence you put to work too, because if the stock is high in the channel, so you watch BHI, and you look at the channel it's in, and as you can see, we've been in a declining channel, but the declining channel is still predictable. You could draw a line across here and a line across here. So right now we're high in the channel. So we're high in the channel. You might want to be a little more eager to fill the short calls, because this is your chance to fill the short calls. Then if we go down in the channel, you're going to fill these. So as this heads down, these two guys are going to fill. Then you'll have to wait for the next swing up, and you've got to be realistic about it. Am I going to hit that price again? Okay, are we going to hit Friday's price? Well, we should, because here's Friday's price. Oh, no, wait, where's 11.13? No, actually, that's weird, because on Friday was the day that the short puts got a good price. And Friday, it wasn't actually that high. It was actually down here, so it's just the VIX was higher. Oh, because it's a year out, that's why. So the funny thing about that is on the way down, even when the stock was going down, because the entire market's VIX went up, the volatility index went up, it pushed all the 2017 prices higher, even though the stock was falling lower. So the price of the long call went up while the stock was going down on Friday. Now we're suffering because the VIX went down significantly. And let's take a look at what the VIX is doing. VIX. That's another thing you want to keep your eye on. See what happened Friday? The VIX was at 20-something, and it's come down since then. And that's lowered the volatility, and that's lowered the prices of the long-term options. So all these things are connected, and the key is to understand how it all works so that you can understand how you're filling your trades and how you're making your trades. These are not just random numbers on pieces of paper. You have to understand what's going on. Otherwise, you won't be able to, it's not like you just make trades based on somebody does it. And that's why I really hate it when people and we have a trade for this on the Top Trade membership. The point of that is because people said, we don't want to hear about the chat or anything else. We just want trades. So the Top Trade membership just sends out trades. That's what we do with the Top Trade membership. You just send out trades. There's an alert to your smartphone. There's an email alert that goes out, and that's it. Whenever we decide to make a trade once a week or so, you get a trade, and that's it. No chat, no nothing. People want that, God bless them, but I think it's the stupidest thing in the world, because if you don't understand what a trade is and why you're making the trade and how to make the trade, then it's almost like a random event if you win or lose. It really is. And I don't understand, if you're not willing to put the time and effort into learning how to do this properly, probably you should just find something else to do, because it's a big waste of time. All right, so that's my lecture on filling something. All right. Okay. Boy, I hate this system. It's so pain in the ass for that kind of stuff. All right, can you discuss saving bull call spreads? Well, that's easy. Okay, here's another one, Stan. Let's see, saving bull call spreads. If you have a bull call spread, let's pick one. Gold. Okay, here's gold. We have the January 106 gold calls. We bought them for $3.30. They're now $1.25, and that's probably a bad price, but we won't want. Well, let's take a look. Let's see what they really are. GLD. Again, never trust your broker's spreadsheets. They're not worth shit. January 106 calls. They are, in fact, 125, 126. And what is this thing quoting me? 124. So not so bad, actually. All right. They are, so basically for $1.25, we have the January 106 calls. Now, that doesn't sound good, but what do we pay for them? We paid $3.30 minus 155. So that's, what, 175? Is that right? Let's see, yeah, 175. So we paid 175 for them. Now they're 125. We didn't really lose anything. It seems like we lost something, but we didn't really lose anything, because what we're going to do is we're going to salvage the 125 and roll these calls. And I'll explain to you how this works. So when you're in a spread, the gist of it is whenever the price of the call you own, of your long position, falls below the net of the spread that you paid, you want to do something about it. And I'll show you why, because if I take this 125 and I sell it, right, I get 125 in cash. Then I put this cash into the March, all right, let's say we go to the March 106. I don't like the 106. I'm going to put money in. I want to get something for it. The 104s, all right? So 125, I'm going to put less than $2 into the March 104. So what am I doing? I'm buying $2 a position and 2 months of time, February, March. I already have January. So I'm buying 2 months of time and 2 months of position for $2. I'm sorry, 2 months of time. 2 months of time and $2 a position for $2. Obviously, paying $2 for $2 a position is a good trade, right? So that makes sense right away. I'm also buying 2 months of time. That's pushing all of my time back. But more importantly, what's the price of a March 104 call? It's $3.15 or something, or $3.16 was the last sale. So it's $3.16. when I take the 125 back from the January calls, I didn't lose money. Even though the call itself lost money, I didn't lose a penny because I'm salvaging the 125. I mean, I did lose. I paid 175, so I lost 50 cents. But in other words, other than that 50 cents, I didn't lose anything. And I'm putting new money, fresh money, into this call. This call is worth $3.15. It's not worth less than $3.15. So all the money I've taken off the January call is now reapplied. But this is, again, why you want to do it before it goes below your net. Because if I had done it with the entire 175, I wouldn't be losing anything. I'm just buying a different call of value with the money I had originally had in the previous call, with the same money. That same net 175. I will be taking that net 175 and buying a longer, better call with it now. So you understand that concept? It's like, how could I explain this? Well, it's like a house, almost. It's, okay, let's say you have a house. And you buy, let's say it's always a two-family house. You have a two-family house. You buy it for $200,000, all right? And then you rent it for $100,000 to somebody else. Then you take your $100,000, forget interest and mortgages and stuff. I'm just saying, let's say you spend that much money. So you bought the house for $200,000, and at the same time you rented half of it, or you gave half of it to somebody for $100,000. Then you sell your half for $100,000 and move out of the house. So you only paid net $100,000 to go into the house. You sell your half of the house for $100,000. You're no longer in that house, and you move out to a house that costs $400,000. So you're putting $300,000 more in, but you didn't lose money because you have $100,000 from your first house. It's the same $100,000 you had in the first place. Now you're just buying a $400,000 house. At the same time, you sell half of the $400,000 house for $200,000. So now you paid $200,000 net dollars to be in half of a $400,000 house when you started out being in half of a $200,000 house for $100,000. Have you lost anything? No, you haven't lost a penny. And you're in better shape. You're in a bigger house. That's all this is. If you do it correctly, you don't really lose you don't lose a lot of money. If something relentlessly goes down on you all the time, eventually you might lose money. You may have to capitulate. It may go down faster than you can roll, something like that. But that doesn't usually happen with an ETF or with steady stocks. And you can often roll your way out of trouble. Now, of course, the key is going to be when we're finally away from the January. So you won't be done with January until the short calls expire, because you still have an obligation to the short calls, the 110s. But you could put a stop on those, and that's going to just add a little bit of cost to the long position you still have. But we're just taking that money, and we're rolling it to the March, what do we say, the March 104s. And that still leaves us with the short 110 calls, but now we lost 50 cents, we spent 175, so we spent 175 plus 2 more, or a little bit less than 2 more for the roll. So now we spent $3.75, but now instead of being in a $5 spread, we're in a $7 spread. In the 104, I'm sorry, it used to be a $4 spread, sorry. It was a 106, 110 spread in January. Now it's a $6 spread. So before, when it was a $4 spread and we paid $175, the most we could make is $225. Remember, like the bigger house concept? Now we paid $3.75 for a $6 spread. We still can make $225. So we're going to make the same money this way. But we'll make more, really, because what's going to happen is those January calls are going to expire worthless. And if they expire worthless, we'll be able to sell something else in March and lower our cost. Or if they don't expire worthless, that means that we're going to get at least the money that we wanted. We're going to get the money. We're going to be $6 in the money. And that means we can then roll the January calls and even so pick up some more money. There's very little bad about this. Even though it looks bad on paper right now, there's nothing bad about a slow, small roll that we can do like this. We just improve our positions. And that's what I mean when I'm looking at this, this portfolio and saying, okay, at the moment, these positions are down, but I don't care what they are when they're down. I care what they are when I close them. That's why the ones we closed, go back to this analysis thing, the ones we closed gained $27,000. The ones we didn't close, I don't want to close. If I close them, then I'll take a loss. And you can't, obviously, you can't avoid losses forever, but the portfolio is still ahead. If I shut it all down now, it's 106, 107. So, and also you get some bad spread, so you'd actually have a little bit more than that. But if I closed it all now, it's still positive. It's not like we're losing money. I'm just saying that we want to work on these positions. They're much longer term and more volatile. All right, so let's hope that answers that question, because that was a pretty good long answer. Oh, the Fed. I forgot about those guys. Shoot. And the Fed just released. Nobody reminded me. Well, probably did try to remind me while I was doing that. All right, what's going on? Damn it, we didn't do our shorts. Oh. Wow, that's a big nothing. Did they release their minutes? No, not Twitter. Let's go to the Wall Street Journal. They know. Well, it doesn't matter what anybody says until, oh, great. Until the Wall Street Journal says it. Hilsenrath from the Wall Street Journal is the official Fed speaker. So whatever he says is what counts. Oh, come on. Are you kidding me? I am a member. Paris suspect. Yellen reiterates opposition to emergency lending curbs. Who cares? Where's the Fed minutes? Oh, this is unbelievable. Nope, doesn't want me to do that. I don't know what my signing is. It's on my other computer. All right, sorry about that. I have to look on this computer and just figure it out. I always got the same front page. I thought I'm missing something. Did the Fed minutes not come out? Am I crazy? I see nothing. Minutes, October 8th. How weird. Or maybe it's tomorrow. Damn it. Sorry. I was thinking it was today. Oh, it's tomorrow. I feel like such an idiot. All right. I'm all sitting here excited waiting for the Fed minutes and they don't come out. All right, screw it then. Sorry about that, guys. Look at that. I thought I had my whole day planned. I blame Craig because he asked what time it is. All right. Is oil heading lower? What are the futures plays you mentioned at the opening? You're waiting for the Fed. I was waiting for the Fed. I thought it was today. Now there's no point. We got to wait till tomorrow. So we could easily. No wonder things are going up today. There's no Fed. Nobody's worried. How annoying. Okay, well tomorrow we'll have some good plays then for the futures. It'll be the same lines as last week, though. I mean, we're basically kind of in the same place where we started shorting last week. I don't think it's going to change very much. CLF, idle to plan to reduce inventory, drop to 241 super cheap. Yeah, I like CLF down here. GLI put, GLL put. Yeah, I like those too. That's a good play. We talked about Netflix. they're going, it's not, look, they're going up. It's not a tomorrow play. They're going up right now. What time is Fed release? Should we sell 2 more BHI puts to get to 5? I would be inclined if they go down some more from here. I'm not going to do it right now. I mean, I think we kind of missed the opportunity to catch them in that channel. Let me see. Look, you can't add things every single time. You can't it's like down here, absolutely yes. Down up here, no. There's 10% difference. It's like almost a 10% difference between there and there. Well, at least 5% anyway. So I don't want to chase it, but yeah, it's not a question you should be asking now. You should be saying as soon as you see a big spike down, you say, oh, I want to add my puts now and see what happens. That's when you have to do it. You have to do it when everybody else is panicking out. BHI calls 217, puts at 218. Oh well, yeah, the puts at 218. But you know what's cool about that though, because when the deal goes through with Halliburton, everything expires at the net price, no matter what the date is. That's why I like selling those 218 puts. But I guess you're probably talking about from the pricing standpoint. Gold, we are naked long the 106 calls. We bought the 110 calls back. Okay, I didn't reflect that in the thing, but that's fine. Same thing then. We're not ready. We're not ready to sell calls yet. But I want to, at this point, roll back those calls to the January 104s. Let's see. Difference in limit order and stop order, and when you get filled at a stop price, poorly worded. Yeah, there's not a stop order, a limit order. There's a limit order. There's a market order. That means sell or buy something at the market price. Never, ever, ever do that. Okay? A limit order means I'm putting in a price I want to sell or buy at that limit. That's what a limit order is. A stop order says I want to sell if it goes past this price. That's an exit order. I don't like those. It's dangerous to use because any little spike in the movement around your price and you'll get knocked out. So that's not something we like to use unless we're like going to be physically away from our desk and can't trade. But the key is a limit order and also making the limit order good to cancel so it doesn't reset itself at the end of the day. A lot of people do that too. A lot of people think they have an order, but then it cancels at the end of the day, and then they go, oh, and a week later they're like, oh, it never filled, and it never filled because your order canceled. You gotta always pay attention to what you've actually ordered and where you are. Let's see. Okay, bull call spreads. I think I did a good job on that one. Let's see what else we got. Oil heading lower. Is it? Well, oil's in a bad spot. I mean, there's nothing really to push oil higher, so it will continue to go lower. GLO, Netflix, different limits. What time is the Fed? We decided there is no Fed. That's why it doesn't work. BHI calls. We said that. Gold is gold. Fed minutes. Okay. Steve was right. Those calls we brought back on November 7th. November 8th. Wow, way back then? I guess I just totally forgot to enter them. Would you sell something else or just roll the calls or mark? Yeah, we're going to roll those calls for GLD. I'm going to put this out. I'll put out official changes shortly. Except I guess apparently first I got to go back to last week and clean up and make sure I didn't miss anything. Thanks, Craig. GLL put questions were because it's GLL is down. Maybe you can talk about patience. What are we talking about? Well, GLL is down because gold is down. GLL is the ultra long gold, right? Ultra short, ultra long, ultra long. One of those ultras. GLL is ultra short. Oh, the puts are down. I see. The GLL is ultra long gold. So when gold goes down, GLL goes flying up. It has a huge effect on the puts. But we're not really worried about the short-term move in gold. So we're just sticking with the GLL puts. And by the way, we took them because we wanted to limit our loss. All right, Steve. Try rebooting, restarting. Starting. Damn it. Yeah, okay. Oh, Steve, yeah. Try restarting if no sound. So I know it's not me now because everybody else is fine. Where was I? GLO, right. Let's take a look at that one. GLO. Here it is. We have the January 110 puts. Again, this is January. It's going to be violent when it does this because it's, well, let's look at GLL. Yeah. That's open up my incognitos. GLL. It's a violent bastard thing. Look how it goes. Up, down, up, down, up, down. We want to catch the down. We took the position around here. We're currently getting burned, but we don't care. It's like if we took it over here and we said, oh my God, should we get out of it? No, this is the next. We didn't know it was going to go up here. We were hoping this was going to be the end of it, but it spiked up some more. But we still certainly think this is going to be the top because this is where we think the bottom is in gold. And if gold comes back from here, this thing can violently go down. Okay, I don't have the conviction at the moment to double down on it or anything, and we have until January. We have 3 months, 1 month, 2 months, 3 months. This is how long we have for this thing to go down. So if we go back 1 month, 2 months, see look, 1 month ago it was at 95 or 92. 2 months ago, it was at 110, where we kind of went in. 3 months ago, it was down at 99 again. Then 1 month before that, 115. A month behind that, back at 99. So it's not a complicated trade. We bought it. We went short at the top, at one of the many, many, many tops. Here's the top. Here's the top. Well, here's the top. From that, here's the top. Here's the top. Here's the bottom, here's the top, bottom, top, bottom, top, bottom, top, bottom, top. Okay? I'm betting there'll be a bottom. I'm betting there'll be a bottom, and I'm betting it comes in less than 3 months. I don't think it's an unreasonable bet. I'm not making any crazy bets. I'm not out of my mind. I just think that the top, bottom, top, bottom, top, bottom, top, bottom, that's been going on for like 5 years, will continue this month. That's my bet. So, I think the question was about sticking with something or whatever. Hang on, let me see what his wording was. It's funny. Can you talk about patience? I don't know what to say. Honestly, Tom, I don't. How about realistic? I don't think it's even patience. It's a realistic expectation. It's having the attention span of somebody more than 5 years old. These things take time. Sometimes they don't go the right way at first. But it's not about patience. Well, it is about patience. It's about patience. But it also is about having a realistic expectation for what things do. We didn't make $27,000 in the 5% portfolio because every time something went against us, we ran out of it. No, what we do is when something's going our way, we take a profit, and when something's going against us, we adjust it and we wait. Now, in both cases, we're checking our premise. If something's going our way, but we think our way has a long way to go, like natural gas right now, right? Natural gas, CO2, whatever the hell it is. So natural gas has recovered nicely, but we think it's going to go much higher. So we're not out of it, but we're still adjusting our position. We're moving our time frame back. It's going slower than we thought it would. And we took some profits off the table. With IBM, we took a little bit of IBM at 140. It's gone down to 135. We're going to take more at 135, and we'll take more at 130 if we get a chance. We're not getting out of it, and we don't care how long it takes to turn around. In GLL's case, we entered this trade on GLL 11.6. Oh, you guys crack me up. We entered this trade 10 days ago. And the January expiration date, I love this, Joe. This is so funny. The January expiration date is 59 days away. So at the time it was a 70-day trade, and now 1/7 of the time has passed. So in the first 15% of our ownership, or 12% of our ownership, it hasn't gone our way yet. I would give it at least another 12% of time, and give it at least another 10 days before I start abandoning ship and freaking out about what's going on. It's just, you know, if I thought it was going to go exactly my way in 10 days, I would have bought the November calls, right? Right? I mean, Novembers don't expire till Friday. We could have made a killing on them. But we took 3 months because we didn't know where it was going to cycle through. We just assumed that within that amount of time we're going to get a cycle. But it goes back to, you have to have realistic expectations. And again, more importantly, you have to understand why we're making a trade. Don't just make trades. Don't get into trades you don't understand. And understanding them doesn't mean I understand I should buy the GLL puts. Understanding them means, why am I buying the GLL puts? What do we think is going to happen with GLL? What is our plan? What are we looking to trade? How much do we expect to make? How much could we lose? And if you're not comfortable with all those things, don't do it. That's how you can have patience. It's very hard to have patience if you go overextending yourself on some trade and you're not even sure why you're in it, and then all you're doing is freaking out because it goes down a little bit. So we bought 5 contracts in a $100,000 portfolio for $2,500, and now they're $1,500, so it's down $1,000. They've affected our portfolio by 1%. If anything, I'd be more inclined to push it or double. If gold went crazy down to 1,000, I would absolutely roll these trades, roll these puts, and double them down. But at 1,000, it's not even worth adjusting. It's 1% of our portfolio. It's not anything. And again, our premise is still intact. We think it's topping out here. The fact that it's spiked up a little higher doesn't mean it's not topping out. So yes, 2 months out, not 3. Well, whatever March is. I mean, I'm sorry, I don't have the exact of each thing. Whatever January is in that case. But if we roll it, if it's not working out our way, if gold goes down to 1,000, this thing goes up to 125 or something like that, and that would be GLL. So we'll look again on this thing. So if GLL goes to 125, I'm still kind of inclined to stick with it, right? So I would then roll my position. Then we'll be in March or April or whatever the hell, and we'll go to a higher strike put. And then if we eventually do get that $20 or $30 drop that we usually get in GLL, we're going to make a lot of money. But we had to put our foot down at some point. So a week ago, and a week ago is this candle here. These are weeklies, right? A week ago is this candle here. In fact, the 6th, if I can see it, here's the 9th. So right about here, when we have this spike up, is when we bought it. And in 1, 2, 3, 4, 5, 6 trading sessions since then, we've gone from 111 to 114 or 115. Actually, well, I don't know what it is now. But anyway, so we're at around 115. So it's gone up $4 instead of down the $10 that we hope it's going to go down. But I think I would certainly give it another 5 sessions and see what's happening. And then if it's not going our way, again, I can't get away from my premise. Look at this one. Spiked up, went the wrong way. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 sessions. So next week, we can talk about this trade. But the longest it's maintained a spike in recent memory is 11 sessions. See this one? This one, I guess you could call this almost a month. See, this is like a month because it was up here, up here, up here, and up here. So that was almost a month it was near the top. But then it still went back down. And there's no month, this is not a month, this is not a month. So, and now we're going back 3 years. You want to keep going back, take another chart and go back 5 years, 10 years, but at a certain point it's not relevant anymore. It's a volatile ultra ETF that goes up and down very quickly. When it's up, I want to catch it. And when it goes down, we're going to be in good shape. And since I only like gold long right now, I wouldn't bet it when it's down here because I think it could go much lower. I think gold can break up and this thing can completely collapse. If we're lucky, we'll catch one of those times. But at the moment, gold is down. Gold is down because, and also why is gold down? Gold's down because the dollar is strong. It's not gold's fault. Here, watch this. GOLD priced in XEU. Here's gold priced in euros. See, gold's not even down in euros. If you go from July till now, gold's at the same price. If you go from the beginning of this year, gold's flat. From last year, gold's up quite a bit. And now if we do XJY, same thing in yen. In yen, it's a little bit lower for the beginning of the year, but as from last year, gold's been holding its value really well. The problem is, though, that you're looking at gold. You're the only people looking at gold in dollars. If you're an American, you're looking at gold in dollars. Nobody else is. Gold in dollars has been going down. Gold in dollars is going down. It's not gold's fault. Gold to everybody else on earth. Gold is flat or up. It's only because it's priced in dollars here that we look at it that way. But if you have a local currency, gold is a fantastic hedge against inflation. And that's why they say that about gold. Gold is always a hedge against inflation. We just don't have any inflation in America. That doesn't mean gold is invalid. It just means we have a strong dollar right now. Gold is a hedge against our strong dollars because if our dollars get weaker, gold will get stronger. If the dollar doesn't get weaker, if gold doesn't get stronger, then that means the dollar buying power, and we have where's that? Oh, I was just on it. We have $82,000 sitting on the sidelines. If those dollars stay strong, then our buying power is strong, and we don't need the gold hedge. But that gold is hedging our dollars. There's purposes to everything we do. Steve says, internet goes, you could sell 2 more puts. I'm not doing it, but you can do it. I mean, in the options opportunity portfolio, I'm comfortable with the amount that we sold. If there was a drastic sell-off, and I think that's BHI you're talking about, if it sells off drastically and I think that it's still a good buy and the reason it went down is for something silly, then yeah, I'd want to sell more puts. But if the deal is falling apart, if Justice Department is challenging it and it goes down, then no, I don't want more shares of BHI than that. I'm not going to be comfortable with that in that portfolio. But that portfolio has caveats. It's a standalone portfolio of $100,000. So I don't want 500 shares of BHI at $100 at $40 a share in my portfolio for $20,000. So I would not do it. If it was my portfolio and I only had $100,000 in it, I wouldn't do it. In the long-term portfolio, where we like to hold things like that, I would double down in a second. But that's because we have $500,000 in the long-term portfolio, and we love having positions for the long term. So so to ask that question, saying if you want to, yeah, but you have to think about how it affects your overall planning. And also you have to think about why you're doubling down on BHI. Why does BHI keep going down? BHI goes down because the oil price is low, because the rig counts are low. But I still for $40, it's $49.47 now. I still for $40 don't mind owning it. But everybody's just freaking out of the oil patch. Even T-Bone Pickens says he sold all his oil positions. It's hopeless. It's mostly hopeless because it's not coming back. I'm not saying it's going to get cheaper. Oil won't get cheaper, but it's not coming back either. And we talked about that, right? We talked about the demand destruction in oil and how every time a new car is sold, every time a person who has a 20 mile per gallon car buys a new car, and that happens 1 million times a month in the United States and about probably 4 million times a month in the rest of the world. Every time somebody takes a 20 mile per gallon car and trades it in for a 35 mile per gallon car, which is the average of the new fleet, they are going to next year buy 40% less gas. 5 million drivers will use 40% less gas next year than they did this year. We're not adding enough drivers to offset that. We're not adding enough new customers to offset the decline. That's monthly. This is every month. 5 million drivers in the world per month are consuming 40% less gas, starting next month because they have a new car. So they fill up yesterday their old car, and they drive to the dealership with a 20 miles per gallon. They then get a brand new car with a full tank in it. That tank's going to last them a month or 2 weeks or whatever instead of a week. That's a big difference. That's an immediate, gigantic difference in consumption, and it's happening every single day. Every time people buy new cars, and they're buying 40 million, 50 million new cars a year. Every single time someone buys a new car, they're not buying more gas. So at the end of the year, 50, 60 million people are using 40% less gas than they used last year. And that accumulates. We're only in the third or fourth year of that. That's going to keep happening for 4 more years. And in 4 more years, the mileage standards go up to 50 miles a gallon, so even the people turning in their 35-mile-gallon cars are still going to be using less gas. Because they'll get 50-plus mile per gallon cars. And who knows, the way electric technology is moving, people may go to 0 miles per gallon cars. So this thing could go, this change in consumption could go on for quite a long time. Now, the world has 1 billion-something cars in it. So let's say the world has 1 billion cars. It takes a long time, even at 40 million, 50 million, even at 5 million cars a month. It takes a long time to replace 1 billion cars. It takes 200 months, in fact. So that's actually, we're doing a lot. In fact, something's wrong with that, because we're doing a lot faster, obviously, than 200 months. So maybe my figure's a half. Maybe it's going twice as fast as I think it is. But either way, the point is, there's 1 billion cars using gas now that won't be using gas. That'll be using 40% less gas in the next rollover of all those cars. So let's say in 10 years. So that means every year, all 1 billion cars are using 4% less gas. And that's going to keep going for the next 20 years until we're down to 0 gas per car, other than whatever fuel is used to produce them, unless that's solar energy, in which case now we're using no fossil fuel at all for transportation. So that's why there's this relentless push down in oil prices. Okay, we're not adding enough new drivers to make up for that fact. In fact, look at China with the pollution and all that. And it's not just pollution; it's pollution and traffic jams. If you ever go to Hong Kong or Shanghai and you sit in traffic for 4 hours, you're not really motivated to buy a car. Because why are you buying a car? You're buying a car so you can park it at a $300 a month garage. You're buying $8 a gallon gas, because it's expensive over there. You're buying $8 a gallon gas with your $300 a month parked car, and then you're taking 2 hours to drive to work that would take 15 minutes on your bike. It makes no sense. So that's why auto sales in China are flattening out too. And then the pollution is killing everybody. So the growth is limited, and we're way past peak auto consumption, and now we're using less and less and less gas every year in cars. And in addition to that, we're switching our light bulbs to light bulbs that consume 1/10 the power of the old light bulbs worldwide. That's happening. Also, a very, very slow rollout. but in 10 years or so, we will use 1/10 the amount of electricity to create electric light also. So that also it's more natural gas. But the point is, it still is lower cost for all of these products, for fossil fuels. That's great. As we start doing it, it's going to help a lot with global warming and all that stuff. But the bottom line is, as far as oil prices go, that's why they're down, and they're staying down. But oil prices, since oil prices are commodities and commodities trade together a lot, it's causing the entire commodity basket to go down. Also, oil is the #1 source of dollar demand overseas, called petrodollars, right? Oil is traded in dollars. Now oil is not being traded for very many dollars, therefore the demand for dollars to move oil is very far off. And that affects prices too. That affects commodity prices, affects everything else. So I'm sorry, petrodollars are weird dollars. It's very important to explain. With a petrodollar, we're trading dollars, we're exporting dollars, and the dollars are being burned, essentially, right? We're sending them overseas, we're trading perfectly good dollars in this country for stuff we burn. We retain zero value after sending the dollars out overseas. So what we end up doing now is we end up having more and more dollars at home. Those dollars are going into the stock market, those dollars are going into bonds and keeping rates low and all that stuff. And also, though, we don't have inflation because oil prices are down, and that helps fight the inflation, even though there are more dollars around. So it's a very, very interesting dynamic going on right now. And it's not coming back. That's the thing. This stuff is not going to come back because we're really moving into a post-oil society. It'll be over the next 100 years, but 100 years from now, you'll need oil as much as you need coal. It'll be the same kind of thing. Where you're going to be like, people say like, well, isn't coal important? You say, not really. We using some electric plants, but other than that, it's not used for anything. You go back 100 years, coal was used for everything. Coal was the most important thing on the planet 100 years ago. Even in World War II, they were using coal to run a lot of plants and stuff like that. Now it's over. I mean, we use coal for electricity, but other than that, we don't really use it. So the world changes very quickly in a long-range view, but in the short-range view, you sit there and go, oh, why is this happening? Or why is this not doing this? And why is it not doing that? It's all going to take fits and starts. But the big trend is oil is dead. That's the big trend. Coal is dead and oil is dead. Coal is dead because it pollutes too much. Oil is dead because it's just not necessary. We're no longer using it for the main purpose of its use, which was the internal combustion engine, as a main use of oil. And by cutting that back, that's 40–50% of all the consumption of oil is going to be out the window. And that means we have a gigantic glut of supply. What do you think the next OCST to mine gold is now? What? I think the cost. Oh, cost. I look, I have to guess what everyone's saying. What do you think the cost to mine gold is now? It was $10.50, but ABX lowered their cost. Look, I always go by what ABX says, because ABX is now saying $9.50. They are the most efficient miner. GG would be the second most efficient miner. Those guys are coming in under 1,000. So that becomes then the real floor for gold. But other guys can't do that. There's not many miners can match that. What ABX did, by the way, ABX didn't do anything magical to lower their costs. What they did is they sold off all their high cost mines. They've always had mines. There are mines where like all you have to do is like just hit the wall and gold falls out. Where they have very low extraction costs because there's tons of gold. There's other mines where they have to sift through like 40 tons of gravel to get an ounce of gold. That's got the higher cost. ABX has sold all their high-cost mines and have kept all their low-cost mines, which now makes them a low-cost producer of gold, but they now produce less gold. Okay, they no longer have that capacity. They've now shut down. Those mines are not coming back. They took the cash for them and paid off their debt. So, paid off some of their debt. But they cashed in a lot of their low production mines, Now, don't forget, for a guy buying a low production mine, as long as it makes 10% or 5%, that's great. For AVX, though, it's a poor producing mine for them. So, you know, if I have $1 billion and I buy a mine that makes $500 million a year, okay, that's still 5% back on my mine. It's not bad. I paid $1 billion and I'm going to get 5% back. It's not a terrible business. Especially if you're borrowing it, leveraging it, and so on and so forth. You know, you're only putting down $200 million, you're getting you're putting down $200 million and you get $500 million back. That starts sounding like some real money, right? so you know, even if the production is low and the rate is low and whatever, it depends on how you finance it and so on and so forth. There's an outside party buying the mine. So ABX can logically sell their mines to other people who are very happy to eke out a decent return on the mine. Whereas to ABX, they've got some mines that are returning 30% on the money, and so they don't want the mine that returns 5% on the money. So they sell those, get the cash pays down their debt, and now they've got the high producing mines. But they're not putting out more output from those mines, so then the overall amount of gold available in the world doesn't change. And it's not like they shut down the production. The other guy who just bought the mine is going to be producing still also. So nobody's shutting down. The new guy who just financed the mine that ABX got rid of is not going to be shutting down production. He can even take a loss for a year or two. He'll keep going. So, you know, when production shuts down, it has to be the small guys just completely give up the ghost and go out of business or shut their mines or lay people off. That hasn't happened yet in gold. So we still have the same production amounts. All right, but I still think gold's going to go up, not because of mining and supply and demand. Gold's going to go up because of supply of dollars, and we're going to hit an inflationary cycle. Not soon, though, because of the Fed. When the Fed's tightening, it's not going to happen, but probably sometime middle of next year we should see gold start to turn around. I didn't hear that part. I want to follow you. I have no idea what you're talking about, Steve. We're talking about BHI. In BHI, the part of BHI is we're happy with the trade the way it is now. That's the answer to BHI. We're not doing anything with it. Tasers under 17 take advantage. Yeah, I love Taser down here, but again, I'm not rushing into anything because we already have a trade. And we're going to adjust it more aggressively, but there's nothing particularly about Taser that makes you want to take it right this minute. I don't know what you meant about lows a day. We're not kind of just drifting along. Without the Fed, I expect to drift, and we're probably going to keep drifting like this until 2 p.m. tomorrow, but then there'll be a nice opportunity to go short on stuff. But as it stands right now, there's nothing exciting going on here at all. I don't see anything interesting here. See, Amazon tested 650 and failed. I like that. Netflix, 118, almost 120, coming back a little bit. We'll see what happens to them also. Apple had trouble at 115. That's not good for them. Nothing really going on here. It's a blah day, basically. It's a flat. Everything's flat, waiting for the Fed. So the dollar, the key for the Nikkei is the dollar. If the dollar gets over 100, the Nikkei can go up and maybe even to 20,000 or something like that. If the dollar does not go up by tomorrow, the Nikkei is going to start going down. So that's one of my favorite shorts still is the Nikkei. If it crosses below the 19.8 line, I'm going to like it short. That's probably, I like that better than almost any of the indexes. 2060 is always a great short on the Russell, though. It's a great short and a great long if it goes over, but it's a really good short if it stays under. And 17.5 on the Dow, of course, is a good line, too, to play. 1160 is good on the Russell, but not 1150. It's a bit dangerous. But this one, 19.8, this can turn into some really big money fast. You can go to 19.2 in a heartbeat. So it's going to very much depend on the Fed, though. If the Fed tightens, definitively says they're going to tighten, or it's spun that way. Of course, they're not going to say anything tomorrow. All they're going to do is have minutes in the last meeting. But if the minutes really strongly indicate they're going to tighten, then the Nikkei can hit 20,000. But at 20,000, I certainly want to short them. So I either want to go below 19.8 or at 20, I definitely want to try taking a short also. But either way, the tight stops if it crosses the line. Oh, man, we're way over time. So I guess we're going to wrap this up, but that's my plan for tomorrow is shorten the Nikkei, at 19,800 for sure. And that's my favorite one. If natural gas gets back to 235, I'm going to like it long again. But if it goes under 235, you got to wait all the way to 230. So tight stops at 235. We don't have a lot of conviction. But then at 230, we start getting very excited about going long on that one again. Oil inventory for tomorrow, don't forget that. If oil gets down to 40, I'm going to like it long. And again, tight stop at 40 is a good line. We were 40.06 here and went all the way to 42. That's a $2,000 move. So watch out for that one too. We'll update all this stuff in chat, of course. And okay, no extra questions, so that's going to be it. Thank you guys all for coming. Sorry we had a little mix-up in the middle, but hopefully we'll be fixing the edit and no one will ever know what happened, other than me saying it right now. All right, have a good day, folks. Take care.